The Fed pause is in effect, and the precious metals have reacted earlier in the day and have since pulled back from their recent gains. We're going to talk about why that is and what the outlook is throughout the summer and the rest of the year as the Federal Reserve has made its stand. Let's explore. The Federal Reserve certainly made a mark today, as most have had expected. The Federal Reserve actually paused interest rate hikes now. We'll get into some of the reasons why and why gold and silver are kind of pulling back a little bit. They are holding the line, which is good, but there's some prospects we're going to discuss throughout what's going on in the summer through the end of the year. I'm going to be referencing an article here from Kitco that discusses some of this and interject my own commentary involved. But before we get to that, hope you will consider pressing that thumbs up button down below and subscribing to the channel if you haven't done so already. I do like to talk about the markets. I'm not a financial advisor, but nonetheless, I think there's a lot of good information you can take from these videos to help you make sound decisions, not necessarily in the immediate term, but through the course of your stacking journey, because it is a roller coaster ride at times, and we have to be able to navigate and withstand the ups and downs of the market. Gold is trading up just slightly now, barely making a move in the percentage-wise. In fact, it's only up 20 cents as I record this video, minutes before the markets close, at $1,944.50. Silver is up 25 cents to $23.98. That's just over a 1% move in the upwards direction. Platinum being below $1,000, I think, is a really good deal for platinum. It's down $1 to $988, and palladium is up $30. Commodities are down across the board, except for uranium. That's up a little bit. But copper, nickel, aluminum, zinc, all down. Crude oil is down. The stock market is mixed, with the Dow Jones Industrial Average down over 200 points, and the NASDAQ is up 53 points. The S&P is also up over 3% right now. Up over 3 points, rather. It's 0.08%. So not a whole lot of movement in the markets, but nonetheless, gold and silver are holding the line, and that's good. There were some gains earlier in the day, but the Federal Reserve left interest rates unchanged. It is maintaining its bias towards more interest rate hikes for the future. In fact, most of the Board of Governors predict that we may see 2 more rate hikes this year. As expected, the Federal Reserve kept its interest rates within a range between 5 and 5.25%. Although inflation has come down significantly from last year's 40-year high, the central bank warned investors that it remains a risk. In fact, this is where the hard work really begins, because some analysts are saying that interest rate hikes are going to be tougher to bring down and tame to 2% from here on out. In other words, the easy work has been done. And I think that's one of the reasons why they're pausing. They kind of want to go on a wait and see to see how it's digested through the previous 10 rate hikes. Recent indicators suggest that economic activity has continued to expand at a modest pace. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, according to a central bank statement. In its policy statement, the committee remains highly attentive to inflation risk. While the central bank has held the line on interest rates in June, the committee signaled that it expects to raise rates possibly 2 more times this year. And they also signaled modest rate cuts next year in 2024. So that's when the pivot will happen. It'll probably be a very soft pivot, but a pivot nonetheless. Holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. In determining the extent of the additional policy firming that may be appropriate to return inflation to 2% over the time, the committee will take into account the cumulative tightening of monetary policy, the lags with which the monetary policy affects economic activity and inflation, and economic and financial developments. So a lot of stuff that they've done now, or that they did 2 rate hikes ago, have really not been revealing themselves as of yet, but they will. The latest economic projections, known as the dot plot, indicates that the central bank sees Fed funds rate rising to 5.6 by the end of this year, up from March's projection of 4.1. And so that is where it is. The pause is here, and it's pretty much clear that the Fed wants to sit on the bench for the summer and let the hard labor do all the work. The reason that the market is moving lower is that the Fed has indicated that more rates will come, more rate hikes, and that the fact is that they were really unhappy with the inflation reading. We would have seen a reaction in terms of an interest rate hike. It is likely that once the dust is settled, the equity market will begin to soar again. And we expect the dollar index to move lower, which means that the current weakness in the gold price could be an opportunity. And by the way, there's been some latest economic projections coming from here. These interest rates on hold, the central bank has turned optimistic about economic growth. The Federal Reserve sees the U.S. economy growing 1% this year, up from the forecast of 0.4%. Meanwhile, the central bank slightly downgraded next year's forecast, seeing GDP growing 1.1%, down from the previous estimate of 1.2%. Economic growth for 2025 was downgraded to 1.8%. Inflation pressures are expected to remain stubbornly above the 2% target. The Federal Reserve sees core inflation, which strips out volatile food and energy prices, rising 3.9% this year to March estimate of 3.6%. Core inflation will remain elevated, rising 2.6% in 2024, unchanged from previous estimates. By 2025, core inflation is forecasted to rise 2.2%, up a tick from March's estimate of 2.1%. Consumer prices are expected to rise 3.2%, down slightly from the March estimate of 3.3%. So they're looking for more resilience in the labor market, with the unemployment rate rising to 4.1% this year, down from the March projection of 4.5%. The unemployment rate is expected to hold steady at 4.5% in 2024 and 2025. And so there's a lot of different factors there. Some people say, well, we don't have enough people to fill the jobs that are needed. But, and how are these employment numbers calculated? Keep in mind that a lot of these jobs, are out there. There can be 2 jobs per person, 3 jobs per person. A lot of people have had to work a couple of jobs and just to make ends meet with inflation and other factors. The economic data that's been published so far, and where the Fed is on this, it's really hard to try to find an absolute objective viewpoint of the data and how the economy really is doing. To me, there's a lot of things that are negative against the employment figures, with many companies laying off, 9,000, 10,000. We haven't heard that recently, but would not be surprising we started to see some of that again. And also the U6 employment numbers are never talked about. How many people are unemployed in those, and how many people have rolled off that aren't counted by the U3 numbers? There's a lot of factors in the economy that I think mean that it's still fragile and delicate. And that is probably why the Federal Reserve has decided to pause now, to really assess and see how the policies and how the Fed rate hikes are going to play out in the coming weeks and months here. So with that being said, I think we're going to have a pretty boring summer with regards to gold and silver prices. I made mention of that. Of course, I could be wrong. It could be a wild summer, but usually the doldrums of summer come in and weigh on the precious metals. In fact, as I've gone through this video, gold is now down slightly before the market closed, and silver has pulled back again below $24 an ounce when it was above 24 today. So it's hard to tell. In fact, as I record this video, it looks like that gold is down now $1.20. So it's interesting, and that's why I think we're in for more suppressed or falling gold and silver prices, lower prices probably through the summer in one form or another. I think later in the year, things will heat up in one way or the other. There may be some economic indicators and data that, and the nervousness of the market, the geopolitical situation throughout the world and everything that's going on, that very well could break. Any little black swan event could have a great effect on the metals prices and the general market sentiment overall. And I think probably what would happen is it'll be a domino effect, or maybe that black swan event could trigger another black swan event, and that could cause prices to go up. This is one of the reasons why I'm overall bullish on gold and silver through the end of the year. We'll see, but nonetheless, for now, it's holding the line. And I think by the end of the year, we could see silver go up to about $28 an ounce. That's my prediction that I'm sticking to. But I think we may still see silver continue to fall through the summer. Gold, I think, will retouch $2,000 an ounce. Think about it. It's not really that far away from it. Now, gold is a much more stable store of value, and it holds the line much more so than silver does. Silver's price increase today is as a result of as a precious metal, as a store of value, as a hedge, because the commodity sector is down, negative overall. The dollar index is down today as well too, which would normally be bullish for silver and gold, and it was until literally within this video we saw silver dip now back into negative territory in a matter of minutes while recording this video. So let me know what your thoughts are on the markets. I hope you found this video insightful, educational, and informative. If so, I want to encourage you to please rate this video, share it, comment, and subscribe.